you were working at a dealership selling cars. So you saw the whole finance side of all the people that were buying cars. Like, what was that like watching people come in? You'd sell them a car, they'd go through the financing, you'd look at the monthly payments. Did you ever like, holy crap, these people are spending a lot of money on interest on these cars?
You're looking at a whole payment schedule as well for monthly payments that's going to the dealership. That's money you're never going to see again. Or also if you just pay cash for vehicles and just paying cash for it, same thing again, you're never seeing that money ever again.
You could structure a loan on a car to buy it and finance it to be the exact same payment as the lease. Do you think more people would have bought the cars versus leased them if the payments were the same for the same car? Welcome back, everybody. Another episode of Solving the Money Problem. Today, I'm here with Marius. And the best part about Marius, I've known his family for a long time, but he got introduced to the infinite banking concept at the age of 16 or 17 years old. His stepdad got him his first policy, and this car behind us was his first experiment with the infinite banking concept. So Marius, tell me a little bit about that intro into the infinite banking concepts at such a young age.
Yeah, you bet. Absolutely. And it's very different than what I was ever been taught about money, first of all. And second part of that is my stepfather had me start with a policy at age 16, told me a little bit about it. It was kind of going in the year, out the other for me. I really didn't know too much about it at that time. And I was just putting money in this thing and letting it do its thing. And at that point, I learned a little bit more about it, read the book by R. Nelson Nash, watched a bunch of YouTube, did my own research on it. Turned out my car was also breaking down at that point as well. So where did I have that capital? Well, I had it from my own system where I just took a loan, paid cash for it, and now I'm in the just process of paying my own system back.
And we're gonna get into that with the audience. We're gonna show them all your numbers, how you do it, but let's kind of go a little bit further. So you were working at a dealership selling cars. So you saw the whole finance side of all the people that were buying cars. Like, what was that like watching people come in? You'd sell them a car, they'd go through the financing, you'd look at the monthly payments. Did you ever like look at it and be like, holy crap, these people are spending a lot of money on interest on these cars?
Absolutely, yeah, you bet. And when people are leasing cars and the next time after the 3-year lease, whatever it is, they come back and their lease payment is not what they thought it was going to be for the same vehicle that they wanted to have. You're looking at a whole payment schedule as well for monthly payments that's going to the dealership. That's money you're never going to see again. Or also if you just pay cash for vehicles and just paying cash for it, same thing again, you're never seeing that money ever again.
Yeah, you lost all that opportunity cost.
Yeah.
So let's talk about leasing, because would you say you leased more cars than you sold, or was it about 50-50?
Yeah, it was about 50-50. Just really depended on what deals were out there. I mean, when I was in the dealership business, the car business, I mean, there were deals out there that were for a couple of months, and then the dealership was like, nope, that's gone now. Hopefully after your 3-year lease, though, that there's going to be something there for you.
But I mean, leasing, like, I get it. I get why people do it. Number one, the payment's lower. They get to drive a new car every 2 to 3 years, which is appealing to just about anybody.
Yeah.
But what they fail to look at is the fine print on the lease agreement where it talks about how much interest they're giving away, because there is interest in that factor. There's the residual value of the car, some other things like the time value of money is baked into there, but also there's an interest rate. And isn't it like 7-8% people are paying?
Yeah, it's not pretty, to be honest. And I've just seen even when they're financing a car, sometimes it's even up higher than that. So, I mean, there is an interest cost in every one of those factors. Absolutely.
Now, let me ask you this. When people would come into the dealership, if you could structure a loan on a car to buy it and finance it to be the exact same payment as the lease, do you think more people would have bought the cars versus leased them if the payments were the same for the same car?
It's just kind of a 50-50 kind of conversation, because people like a new car, after their lease, and they want to maybe they don't even want to stick with that same car because they want something else. Or if it's a car that they finance and own, and then they got to make sure they're taking care of that thing on a monthly basis.
You should go back, get your job back at the dealership, and put a big sign above your desk that says, I'm the guy who can get you all the money back for every car you buy, drive, and own. Come see me. And then see how many people actually come over. Oh, what is this? Get all the money back. I want to know that. But that's what we're going to get into, is how cars like this or any other car, you can get all the money back for the car by changing one thing and adding one step. And that's really what we want to focus on, is showing you how Marius is using the infinite banking concept, how he's using it for this car right behind us, the freedom, flexibility he has, but also his perspective, because he comes from the dealership side of selling cars. We're going to show you the numbers. You can be the judge, because a lot of people are like, oh, I'd never use my policy to buy a car. I don't know. You're living proof of doing it. People, I've heard it from me so many times, I don't think they really want to hear it anymore. So what was it like? You're 16 years old, Eric, your stepdad, gets you a policy, and like, did you even know what it was?
No, not even one bit. And at that point, I mean, I was just working a regular W-2 job, and he was like trying to explain it to me, and I kind of got it, but then at the same time I didn't all, and I'm just like, all right, I'm just thinking of it as like a savings vehicle. That's it. Okay. And I don't know what I'm going to use it at some point, but I mean, it sounds like it's just life insurance. That's it.
It's interesting because Eric saw the presentation. We helped him out with some other family members. And then like you came into the picture and he's like, we got to get Marius set up. And here we are. Now it's kind of just funny because now fast forward to, how old are you now?
23.
23. So we'll go 17 to 23. 17 is basically when you got your policy. You're 23 now. And now you're working as the second in charge at the advanced markets team, working with the one and only, the man in the sheets, Mr. Craig Yenny.
That's right.
And teaching everything. So here we are. But, listen, for the audience, I really want to get into the car, and I know this car, and these are sweet cars. Like, do you want to talk just a little bit about the car real quick?
Yeah, it's a 2021 Genesis G70, and I mean, I was shopping everywhere for even just a good deal because it takes some homework to shop for some good deals out there. And I wanted a car that I really wanted. I wanted to drive it for a while. I know I'm going to want to drive it for a while, and I found it just a really great deal out there. Found it at the exact price point I wanted it to be at.
How much was this?
I think it was a little over $23,000. But yeah, so it was at that point where I just saw it, got a really good deal, negotiated. I've been in the business for a couple of years, so you can negotiate. I knew how that worked. And, but it was just a car that was like, this was definitely meant to be for sure. And it's fast, it's quick, it's a lot of fun. So
I love it, love it. Well, let's actually show them the numbers. You got your laptop?
Yeah, absolutely.
All right, well, let's dive in and let's show your screen because it's super windy out and my hair is doing some funky things here every time the wind goes. But like, show them what you paid for the car and then how you're gonna get all the money back for this thing.
Yeah, you bet. So I had to put a $500 deposit down. It was actually a car I got in the Virginia area, and the total amount due was $24,488.75. That is what I wrote a check for from my banking system. Was a wire transfer that went to my bank account within 3 to 5 business days or so. Was ready to go, sent it to the dealership, and that was.
So you didn't do any credit applications. They didn't pull your credit. Nothing. Just this is how much I need. You just plugged a couple numbers in, and voila.
That's it. Couple of buttons. They just ask you how much money you want. Where do you want it sent?
Love that. All right. So let's show them your policy a little bit. Like now, how many policies do you have today?
So yeah, I currently just have the one that I set up with when I was 17 years old. Currently still in the process of, and it's a 10 pay, which means just really I'm only able to fund it up to those 10 years of the policy. Then after that, I have no extra room to put any more in. It's not as I know a typical way that we design our infinite banking policies, but can really still be an incredible design.
And I think that was more Eric wanted to do that because Eric knew, him and your mom were going to fund it, for a period of time. And they're like, hey, I only want to be on the hook for 10 years on this thing, in case Marius doesn't pick this up and run with it.
Right. And also too, they switched me to be the payer and I started funding it too at that point.
What age did they do that?
I think it was just a couple of years after that. So, hey, you're working now. You're going to start funding this thing. So, it's not on my hands. So,
but I bet you started appreciating a little bit more when you're writing the premium deposits.
Yep, absolutely. So it just came out on auto draft and had that going through the system. And, I got to that point where in my policy, you'll see in the illustration that it is more of a traditionally designed whole life policy. It isn't really especially designed with paid up additions, but just me having this at a younger age, a juvenile policy, having this on for 10 years, I mean, I'm already cash on cash, looks like in year 5, where at that point, I'm putting $1 in this thing and I'm getting more than $1 out. Where I put in 5,000, my cash value growth is now over 5,236. And same thing with the next year 6 of the policy, I put in 5,000 annual in there. My cash value growth is over 5,556. So that's the benefit about this savings vehicle is that whether I leverage any of this cash value that I built up on this non-guaranteed side, I'm going to still getting this cash value growth every single year, whether I leverage my cash value or not.
And you're so young. My gosh, what does that look like when you get to the older years? Like, I don't know. I mean, older for you would be like when you're 35, what's your cash on cash then?
Yeah, I mean, at that point where I don't have the cash on cash return just yet because I'm done after the 10 years, but at age 35, year 19 of my policy, I mean, I have over 82,000 of cash value ready to go.
Wow.
And so all that from just putting in a total cumulative premium over the 10 years is 50,000. And I mean, I'm
So
cumulatively
50 to get 80.
Yeah.
Now, a lot of people would be like, oh, that's a terrible return. You know, that's the big thing. A lot of people, when they look at this, you know, and they immediately, especially financial advisors, they immediately are like, oh, that's a terrible return. You would have been better off putting money in a Roth or in stocks. But what they're failing to realize is the money that goes into the policy, that return. I mean, he put, you know, well, what age was that at?
So yeah, at age 35, I have
35. So you put in 50 and you got roughly 80. And that would be, you know, just a couple % on your money every single year as an IRR. But the whole idea is not to just put the money in the policy, leave it sit. As Marius, you know, will soon tell you, the goal is to put the money in, find a use the money to make money twice. So Marius, you're not just making the return on the policy, because that's just a basic 10-pay policy. It's not even a specially designed one, because you know, he set that up prior to knowing about infinite banking. But now you get that return on the policy plus the money you're recapturing from the car. So let's go into the car. Again, tell everybody a little bit about the car. It's what year is that?
Yeah, it's a 2021 Genesis G70.
Okay, so you paid 23 and change, I think you just showed everybody?
Yeah, so $24,488.75.
Now, how did you structure your loan from your policy and your recapture? Like, talk a little bit about your methodology, because everybody can do this any way they want, but how did you do it?
Yeah, absolutely. And you know, that's what we have the Vault software for, to really just see the numbers on how long it's going to take, what my actual APR is on the actual loan interest of the policy. And so, you know, I just started off with, hey, you know, I'm just going to put $250 a month back to the policy loan and just see how that goes. And I plugged it into the Vault software, and it's pretty wild. Not that I want to have this car payment back to myself, for it would actually be 125 payments. You know, it would take some time, 10 years to get the car paid off. Not that I would do that, but a lot of people, what they don't know about the policy loan interest rates is every dollar that goes back to the policy loan goes right to reduce principal. They calculate the interest cost, and they actually put it off to the side. That is what makes such a difference between like lines of credits or anything. With the policy loans, you keep putting money towards the principal of that policy loan. I'm even looking at my numbers. If I just paid $250 a month, my actual effective APR is only 2.9% on an annual interest rate of my policy loan, even though if it was 5.52, my actual towards the end of that policy loan, I only paid 2.90% on that loan.
Your effective yield or your effective APR is much lower because you're repaying principal down.
Yeah.
Now, how much did you look and see how much the car payment would have been if you financed this car?
Yeah, it was like a little over $400 a month. But, you know, I realized too, I'm just like, I want to get this thing paid off as fast as possible. Number one, it's going to just keep buying down the APR faster. And by that point, again, I'm going to have all my cash value built up and ready to go. That's where it can get pretty fun, where I got a car paid for, I got all the money back. And number three, I mean, what if I get
the interest that you would have lost on financing the car or not earned if you paid cash for it.
Right.
So the other thing too here I want to make sure that we hit on is you chose $250 a month. Was that just a cash flow thing? That was just like what you wanted to like pay, because you got to decide how much you paid for the car.
Right. Yeah, and I just started to do that just to kind of start the process of going. I wasn't putting the full amount of the cash flow just yet of, you know, putting, hey, this is the same amount you would get from a traditional dealership. You're going to run that same amount in the policy. I was just wanting to kind of test the waters out first, starting with the $250 a month. Then I just saw what my actual monthly payment would be to a bank. So then I was like, okay, now I know what that is. Well, I'm looking at the calculations on this. What if I just did $500 a month? What does that look like over time? And that, again, is just going to lower the interest cost
and is
over time.
Is that what we're looking at right here?
Yep. Yeah, so if we take a look at the numbers during that whole process, I mean, my effective APR is now only on a 5.52 loan interest rate. That was my policy loan interest rate. My effective APR is only 2.73%. So that's
you make
54,
the arbitrage between those two.
Yep, because so it's 54 payments, 54 months that's going to take to get my policy loan restored. And yeah, that's not even counting the growth that's going on uninterrupted in the policy. So I actually just made money using this as my own banking system to purchase a car. I made money twice.
Hey, so for everybody watching this, I mean, just hopefully you're understanding that. I mean, it's the exact same thing a bank does. I mean, Marius literally is duplicating exactly what a bank does. So when you borrow from a bank, A bank is going to give you an interest rate. And what was the interest rate the banks were willing to lend to you on this?
Yeah, it was like 6-7%.
Let's say 7%. Let's say the bank's willing to lend you at 6 or 7% on a car loan, right? Marius can borrow from his policy at 5.25, at 5.25. So if he's going to give away 6 to the car dealership and he can borrow at 5.25, effectively, if he flips that, he's making that spread. But see, it gets even better because remember he said he's buying that rate down through the APR because he's the bank. He's doing the same thing. A bank pays you interest on your checking account, lends that money out at a higher rate, makes the spread. He just told you his spread. The insurance company charges him 5.25, but your effective yield or your effective APR is how much?
2.73 now. Now I'm doing $500 a month, which is just buying that down even more.
So and again, he had the flexibility. He could pay $250 a month on the car, or he could pay $500 a month on the car, or he could float and change that anytime based on his cash flow. So you can see you can't do that with a bank. Can't be like, hey, Mr. Banker, I don't want to make a $500 car payment anymore. Can I reduce that to $250? I'm just struggling a little. The bank doesn't say, oh, yeah, no problem. Just keep sending us whatever you want. No, but you can because it's your banking system. You make the rules. But again, back to the yield. So, or the arbitrage. He's paying 5.25 to the insurance company, but his effective APR that he's actually paying is 2.5. Let's just say 2.5. Now, 2.5 minus, the amount the cost of his capital of 5.25, that's his spread. He's doing exactly what a bank does, That's how banks make money, and you're doing the same thing. But you're actually making more than that because the policy is still making a couple percent net. We just demonstrated that. So you're making money on the yield, on the spread, plus you're making the interest rate on the policy. You're making money twice. And you get all the money back for the car.
Yeah, it's a good deal.
It's not a bad deal.
Right.
What else you got here you want to show us with the Vault?
Right, yeah.
The Vault does all this for you, right?
You got it, yeah.
Explain that.
Absolutely, yeah. The Vault software, it is the operating system for the infinite banking concept. And really, it's a lot of modeling of what we do on a day-to-day basis with folks, whether, hey, you need to figure out how to get your debts paid off. Number one, we do modeling strategies for that. Hey, maybe you need to save some capital for a major purchase like I just did for a car purchase, or maybe it's a home remodel. Or on top of that, there's a feature in there called the gains projector that you can model out some investment opportunities that like, and understand, whether it's private lending, mortgage notes, whatever it is. And it's really just a whole system, really just to do all these modeling strategies. And it's a lot of number crunching, but it's a lot of fun.
Yeah, that's great. And it would literally just walk you through step by step on what to do, and also tell you exactly how. So just like a GPS in a car, I would assume this has got GPS, right?
It sure does.
You just put an address in and it just takes you there and tells you the best, most mathematically efficient way to get to your destination. The Vault does the exact same thing with whatever you model.
Yeah, absolutely.
Man, I love it.
You got it. And it's just pretty wild because I do working in the car business from how they finance cars. Even if people, why don't I just pay cash for things? Why don't I just pay cash for a car? And they're like, now I'm going to have 2 streams going on of the monthly premium deposits and the policy loan. They're like, how do I do that? But remember, like we were saying, you're in total control of the policy loan, which is the great part about it. I'm thinking of that ongoing premium deposit. That's what I'm saving every month. That is my savings. And even if you did save up 20, let's just say 20 grand of cash in a regular savings account, you paid cash for the car, don't you want to pay your savings account back up and fill that back up anyway? So you're pretty much doing the same thing with this, but exactly the part is that the full amount never stopped compounding. It kept on earning uninterrupted.
Craig ran that once. He showed buying a car cash, from a bank account. He took the money out of the bank account withdrawal, bought the car, and then made the payments back like we always teach, recycle and recapture. So he ran that. Then he ran the policy where he did the same thing, took the loan from the policy, bought the car, recaptured the exact same amount. The difference was the policy never stopped earning on the original 24 grand in the case of this car. So that 24,000 from the bank account, if they were earning 3%, they're earning nothing when they take 24 grand out because no money's left in the account. But your policy, you're not using your money. You're leveraging your money, your cash value, as collateral. You're using the insurance company's money at 5.25, and then your policy. I mean, you're with one of the carriers. You're at 6. What is the 6.6?
But yeah, I think it's about
6.6 dividend crediting rate, which isn't the important number, but I mean, still, it's a starting place. That's what you're making. You're making a guaranteed interest plus dividends on all of your money, no dilution.
Yeah.
I mean, that's the other thing. You're making uninterrupted compounding interest.
Right. And that's another thing, too, about this whole picture is that I like to call the policy as like the foundation starter of really building wealth, because I don't look at it as, the policy is going to get me rich one day. but it hands down is going to be a lot safer of a place to store that capital than leaving it in a bank, number one. And number two, the great part about it is you're absolutely right, like what you were saying earlier. It's something that I can use right now at this young of an age of using it for cars, paying my system back, use it for investment opportunities, starting a business, whatever it is, all while the full amount is going to be compounding uninterrupted.
Love it. And if people want to learn more about the vault, what would they do? How did they get a hold of you?
Yeah, absolutely. If you wanted to go to BYOBvault.com, I think that's a very great place to start. There's demos if you want to learn how to use it. There's actually a book out there that my mentor Craig Yanni wrote that's on there, The Debt Blaster Trifecta. Definitely a great place to start just looking at that information. And then we also have a support team, so you'd be able to reach out to us. And I work with the support team in the vault as well, so always helping
We'll
out
put
with
the
that.
link right up in the description so that people can click that and talk to you, because I'm sure they're going to want to hear more about how you did this with the car. I hope you guys enjoyed that as much as I did. Another solving the money problem, and Mario is showing you how he bought this really awesome car and how he's going to get all the money back. Now it's time for you to do the same thing. So I got a video for you right here. How to get all the money back for your dream car. Check the video out. Let me know how you like it. It's a lot of fun to watch. See you on the next one.